The Federal Reserve meeting was one of the most anticipated events ahead of the holidays. As widely expected, the FOMC hiked by 0.25%. Now, the Fed did lower its forecast for rate hikes next year, as well as growth and inflation. Now, initially, we saw equity markets, gold, as well as the dollar index pull back. But keep in mind, this hike was the fourth this year and the ninth since tightening kicked off in late 2015. Today, I'm joined by Jim Rickards, author, commentator, as well as strategist. I am fortunate to have Jim hang out with me on Fed Day. Jim, great to have you here today.
It's great to be with you, Remy.
Well, it's very interesting what we saw after the Fed announcement. Now we have the chairman speaking, but in terms of expectations as well as market reaction, what does this tell you?
Well, obviously they raised rates, and the surest sign that we're going to raise rates was when the president told them not to, because obviously they can't be pushed around by the White House. But they were on track to do that. There's a basic Fed model, and this actually comes from the Fed. They're going to raise 4 times a year. Every March, June, September, December, 25 basis points, like clockwork, unless one of 3 pause factors kicks in. The 3 pause factors are disorderly markets, and that doesn't mean down 5%, it means down 15% in 2 or 3 weeks, kind of thing we saw in August 2015. So then they'll pause in that event. If you had job losses, we don't have that. The economy is still creating jobs. If you had job losses, that would get them to put on the brakes. But the third thing, and the one they're most focused on right now, is a strong form of disinflation. We're not to deflation yet, but just the fact that their benchmark PCE core deflator year over year is going down, which, well, it's rising at a slower rate, is enough to kind of get them to pay attention. Now, the dots, you can skip the dots. I've spoken to Fed governors and people who, kind of work right next to Jay Powell's office. They say that they don't take the dots seriously. They wish they had never started it. I know Wall Street does, but Wall Street has to do something. So you can forget the dots. They bounce around. But they're watching that disinflation. So when they say we've lowered our expectation from 3 rate hikes to 2, all right, is it going to be March and June? We'll see next September, So I would say they're staying on track. They are data dependent, but the data they look at are the 3 things I mentioned: jobs, disorderly markets, and disinflation. If the stock market goes down 5%, 10%, they don't care. They don't care if it happens over months. If it happens over weeks, that's different.
Well, Jim, that does bring me to my next question. You've witnessed and been through lots of different types of financial crises,
Right.
as well as bailouts. And I know that you continue to watch the debt to GDP ratio. So what do you think the makings of the next financial crisis look like, and what signs are you watching for?
Well, I do watch the debt to GDP ratio very closely. Now, right now it's about 106%. It's the highest since World War II. But I say, well, at least we won the war. We got something for the money in 1945. Today, it's not quite clear what we got for the money, but we spent it anyway. 106% is sky high. You'll hear economists say, it's only like 78% or 79%. That's because they don't count the Social Security Trust Fund. I do count it, and other analysts do, because are you not going to pay those people? You'll talk about riots in France, you'll see riots here if you don't pay Social Security. So I include that, as you should. So it's 106%, which is quite high. Now here's the point. It's going up slowly, 106, 107, 108. We're going to start to run $1 trillion deficits. We're catching up to France, not too far behind. Actually, we're ahead of France, I misspoke. We're catching up to Italy, which is a perpetual debt. So that's a bad thing, but it has immediate effects. By itself, it doesn't mean you're in a crisis, but the research is very good that when your debt to GDP ratio exceeds 90%, there's no way out. You're in the red zone. This is Ken Rogoff and Carmen Reinhardt of Harvard. You're either going to default on the debt, which we won't do because we can print the money. You're going to have hyperinflation because you do print the money. That's the most likely outcome. Or some other form of debt repudiation. But worse than that, it slows growth. Actually, when you start out with debt, you get a pickup and then it levels off, but diminishing marginal returns actually go negative. So now as we borrow money, we don't get any growth for it.
I know we'll continue to monitor that ratio, but when it comes to the volatility as well as uncertainty in the general marketplace, we know that a lot of headlines as well as developments regarding trade, tariffs, as well as sanctions came into play this year.
Right.
So for 2019, what do you expect to see, Jim?
Well, I said in early 2018, when Trump first announced tariffs, and by the way, the process with tariffs, they're not instantaneous, so the president can announce them, but then they have to publish notice, get comment, have hearings. They do go into effect, but it can take 3-6 months, sometimes longer. So he started this in January 2018. Wall Street sloughed it off. They said, oh, he's just posturing. The Chinese are just posturing. This is for show. They'll work it out, the art of the deal and all that. I said, no, this is a real trade war. It's going to get worse. It's going to last for a long time, and you better take it seriously. And now here we are, almost a year later, and all that has played out as I expected, which is world growth is slowing, disinflation is part of that, and okay, now we're in some negotiations with China. We'll see how they work out. But you have to know Bob Lighthizer. He's the key to this whole thing. He's a trade hawk. He's been doing this for over 30 years. He knows exactly what he's doing, and he's not going to settle for half a loaf. Either the Chinese are going to have to make major verifiable concessions on theft of intellectual property, direct foreign investment, and a couple other key things that are not all trade related, or the next round of sanctions are going to go in place.
And Jim, not only are you a strategist, but you're also an editor as well as author. So you have to keep an eye on what's happening out there in the world. And there are plenty of risks outside of the U.S. when it comes to geopolitics as well as politics. And we know that everything is intertwined.
Right.
So when it comes to the axis of gold and the sanctions, can you give us a better understanding of how you expect these fundamentals that affect this to play out?
Sure. Look, U.S. trading partners have been complaining about the dollar since the 1960s. Back when we were on the gold standard, they still didn't like the fact that the dollar was the leading reserve currency. And today there is no gold standard. There's gold, but there's no gold standard. So we just print the money and pay our bills and go sort of merrily on our way. So, but the problem is we weaponize the dollar. When we put sanctions, how do we actually do sanctions? So you're a Russian oil company, or you're a Chinese technology company, or Iranian, and I want to put sanctions on you. How do you do it? Well, first, you kick them out of Fedwire, you kick them out of the dollar payment system, so they can't pay for things in dollars or receive dollars. Then you lean on SWIFT, that's the Brussels-based global message traffic network for all financial transactions, the sort of the beating heart of the nerve center of global finance. You kick them out of SWIFT. You kick certain companies out, so you just keep dialing it up. Well, that's like cutting off someone's oxygen supply. You can't do business today if you rely on dollars, if you're kicked out of this payment system. So it works. It's very effective. But the other countries, Russia and China and Turkey and Iran and North Korea and others, are saying, how do we get out from under this dollar system? Well, you have to create an alternative. Nobody wants a Russian ruble. Nobody really wants Chinese yuan. Those countries don't have good rule of law. But if you build up enough gold and had a gold-backed currency, imagine a digital distributed ledger, blockchain. So you have an encrypted distributed ledger with a new form of currency called a Putin coin or Xi coin, equal to 1 SDR, backed at some level by gold. And now you have what I call the axis of gold, which right now is Russia, China, Turkey, and Iran, but other countries could join. And so, Iran sells oil to China, China sells infrastructure to Russia, Russia sells weapons to Turkey, Iran buys weapons from North Korea. So there's all this trade going on. And instead of keeping score in the dollar, you keep score in this new cryptocurrency. And then 2 or 3 times a year you settle up, but you settle up in gold. And you would settle up net, not gross, so that you need a lot less gold. So that's actually happening. That's not some Jules Verne science fiction story. I mean, they're building the blockchain. They're acquiring gold. Russia and China have more than tripled their gold reserves in the last 10 years. Iran has a lot of gold. No one knows how much. They're non-transparent. Turkey's acquiring gold. Others are doing likewise. So the makings of a non-dollar payment system backed partly by gold are already in place. And that's the way out. You can't beat, first thing I learned in Washington, you can't beat something with nothing. If you don't have an alternative, you lose. Well, they're building something to undermine the dollar.
Well, Jim, that brings me to my last question for this segment. Earlier this year, you as well as Jim Altucher did stand off at the Comedy Club here in New York, at the Stand-Up Comedy Club, and you were discussing cryptocurrency. Now here we are at the end of 2018, and Bitcoin is a lot lower than it was last year. So what do you expect to see heading forward? And another thing is, earlier this year I spoke to someone who's also quite a contrarian, and he was saying that Venezuela is a great place to invest. And interestingly enough, the indigenous indigenous people of Venezuela, because of the dire situation in terms of the economy, they're resorting to open pit gold mining in areas that were considered very sacred to the indigenous people, and they're selling it to the central bank, and because of sanctions, they're selling it to Turkey. So that's really interesting when we look at different parts of the world and what they're doing with gold. So for cryptocurrency as well as Venezuela, what do you expect to see?
Well, right. I was in this debate with James Altucher, who's a great guy, by the way, very smart, very funny. And it was gold versus Bitcoin. And I always get dragged into these debates, and I can't stand them because to me it's like fish and bicycles. They're two different things. You can like them or not like them, but anyway, I get into all these debates, and we had a good crowd and a good moderator and all that. But Bitcoin in December 2017, it was going up almost $1,000 a day. It was going 7,000, 8,000, 9,000, 10,000. It was kind of the height of the bubble. And I did an interview, and I said it could go to 20,000. This is when it was at 8,000. I said it could go to 20,000, but then it's going to crash. It's going to go back down to $200 a coin, not 2,000, but 200. And that's exactly what happened. It hasn't gone to 200 yet, but it went to 20,000, crashed down today around 3,500, give or take. That's down. I think that's about 80%. The thing people don't understand is you can lose 50% more than twice. You can lose 50% 100 times because it's every day it goes down 50%, down 50%. It keeps going. I wouldn't touch it, don't own it, don't like it. I didn't like it when it was 8 going to 20, and I certainly don't like it on the way down. So Bitcoin's a dead end. It's not scalable, it's not sustainable, it's not good for much. It's never been more than outright speculation. If you want to study it in terms of how economists would think about it, you would call it a collectible, like a Beanie Baby or a pet rock. I mean, you can still get Beanie Babies on eBay. They haven't lost all their value. So I see Bitcoin going to 200. I see it falling much lower, not good for much. Having said that, there are 2,000 cryptocurrencies traded on some of the leading exchanges. So it's hard to talk about cryptocurrencies unless you specify which one.
Definitely.
So my question is, who's behind it? Who's the sponsor? Who are the partners? What's the governance? That's the single most important thing. What's the application? What are the transaction costs? You have to analyze a cryptocurrency the way you would analyze a company, and some of them are awful, and some of them are good, and some of them have a future. So as far as Bitcoin is concerned, it's just going to keep going lower.
Okay, Jim. Well, great to get your insights on all these topics. So thank you so much for joining me.
Thanks, Remy.
Thank you.